What's the scenario with the UK's economy? Recently, there's been a decline in housing prices. That's because rising prices have reduced people's purchasing power, while higher interest rates have made mortgages more expensive. Let's dig deep into the UK's mortgage crash. The patterns of house price growth over the previous 15 years were extremely different, and these new shifts build on those patterns. Prices in Northern Ireland have not yet reverted to those from before the global financial crisis of 2008. In contrast, prices in London and the South East quickly recovered until 2015. After the epidemic, when many people moved to less expensive areas in quest of greater space, they had slower growth. New mortgages are more expensive when interest rates rise. Asking prices have not decreased far enough to offset this. Therefore, it's unlikely that first-time buyers will find home ownership more affordable shortly. If salaries grow more quickly than home prices do over time, housing will eventually become more affordable. These long-term developments also depend on how well the housing market performs. In June, the UK's housing market had its fastest annual decline in 12 years, as pressure from steadily rising mortgage rates increased. According to Halifax's most recent price index, real estate prices fell 2.6% in the year to June, the most since June 2011, and a substantial increase from the 1.1% annual fall seen in May. For the third consecutive month, prices decreased, falling 0.1% since May. The average price of a home in the UK has dropped from a peak of £293,992 in August 2022 to £285,932. Following the catastrophic fallout from the UK's mini-budget in October, which saw mortgage rates soar and house values collapse, Kim Kinnaird, director at Halifax Mortgages, said the annual decline masks a tiny recovery in prices this year. Average house prices are up by 1.5% so far this year, with most of that growth coming in the first quarter, following the sharp fall in prices we saw at the end of last year, she claimed. On the other hand, she continued, the housing market remains sensitive to volatility in borrowing costs. Over the past year, rising borrowing prices have plagued homeowners and prospective buyers, as the Bank of England has attempted to control inflation that has remained persistently high. In June, the Bank of England increased interest rates for the 13th time in a row, this time by an unexpected 50 basis points, bringing the base rate to 5%. In May, UK core inflation increased month over month. High levels of inflation and higher benchmark bank rates have increased UK sovereign gilt yields, which are used to calculate mortgage rates. As a result, some lenders have raised rates or discontinued specific products. The most recent rate increase was not completely reflected in Friday's housing data, according to Sarah Coles, head of personal finance at Hargreaves Lansdown, which likely means further hardship for borrowers. According to Moneyfacts, 2-year fixed rates began June at just under 5.5% and 5-year terms of 5.1%, and they concluded the month at 6.4% and just shy of 6% respectively. When new rates are reflected in the data, all eyes will be on the potential damage, Cole said CNBC. She said that as prices continue to decline this summer, higher mortgage rates appear destined to exert additional negative pressure on the housing market. To move their properties, sellers have already begun to lower the prices. According to Zoopla data, 1 in 20 people cut their hair in May, with a 9% average. Price reductions will probably spread much more during the summer, and housing prices could drop even further, she warned. According to Knight Frank's head of worldwide research, Liam Bailey, the domestic property market has further to fall in terms of pricing. The real estate company reported that the first quarter saw a 3.1% yearly decline in UK house prices in its most recent global housing index, which was issued on Wednesday. First-time buyers will appreciate cheaper costs, but higher rates imply affordability will remain a challenge for the majority of new market entrants, he said. The Bank of England is anticipated to continue its tenacious efforts to control inflation by rising interest rates through the remainder of this year. Market observers currently anticipate rates to peak between 5.75% and 6% in November. However, JP Morgan warned on Thursday that rates, under some scenarios, may reach 7%. According to Matthew Ryan, head of the market strategy at the multinational financial services company eBury, markets have continued to ramp up bets in favor of higher Bank of England interest rates in the past few days. Swap rates now see a terminal BOE base rate of 6.5% by mid-2024, a total of 150 additional basis points of highs. As a result, mortgage rates are expected to increase before decreasing, which would hurt some homeowners and exacerbate the UK's escalating rental crisis, as buy-to-let landlords either pass on increased mortgage repayments to renters or leave the rental market altogether. The assumption is that mortgage rates will remain higher for longer, and the pressure on household budgets will continue to put downward pressure on housing prices over the next year. year, according to Halifax's Kinnaird. Markets now forecast a peak in bank rate to over 6%, he added. The carnage in the mortgage industry and impending forecast of a significant increase in borrowing costs have prompted analysis to predict that house values may decline by as much as 20% as a result of the unrest in the UK financial markets. The housing market has been defying the doomsayers for months, despite the tightening cost of living pressure. The upheaval caused by Kwasi Kwarteng's mini-budget may finally be paused to change that. A decline of perhaps around 10% is what senior technical mortgage manager Ray Bulger of home loan broker John Chargall forecasted for the coming year. According to analysis at companies like Credit Suisse, it may be between 10% and 15%. Some people assert that it might even be worse than that. What could be worse than a 20% drop in housing prices? How about they don't crash by 20%? With increased borrowing prices, inflation, and decades of more restrictive mortgage lending, the UK real estate market confronts the possibility of freezing solid rather than declining. And that could be the worst of all worlds, claims a recent Joseph Rowntree Foundation analysis. In this case, low unemployment causes very few forced sales, which results in little change in prices but stagnant transactions, a halt in construction of new homes, and cash-rich investors swooping in to outbid individuals of lower incomes. The end effect is similar to what we have today, but worse. Rents spiral upwards while home ownership remains out of reach for all except the wealthiest people. This situation could endure for years, and no one gets to take advantage of lower costs when the cycle resets. But is that worse than a collision? A woman who had worked for Citizens Advice 30 years prior told when she considered the people affected by the early 1990s recession, which saw a 36% decline in housing prices in the southeast and a 20% decline nationwide, she still got choked up. The worst were those who came to visit her with bundles of unopened bills in an attempt to hide how awful things were from their relatives. Toby Lloyd, a co-author of the report, says, "We have the kind of folk memory of the house price crash of the early 1990s. We haven't realized how much has changed since then though. Homeowners today are significantly less vulnerable to price declines than they were in the 1990s or even 2008. According to the English House Survey, the majority of homeowners in England have not had a mortgage for the past 10 years. The most eye-catching policy suggestion in the paper includes giving councils specific authority to restrict who can buy in their region. This would prevent large home builders from shuttering projects until market conditions improve and would stop investors and corporate landlords from scooping up houses. The average price would only return to where it was at the beginning of the pandemic if UK property prices dropped 20% from their peak last year." Neil Hudson, another report co-author, said there will be people who suffer from negative equity, but there will be thankfully relatively few in number and help can be provided. Stability is the main concern. How likely is a market freeze of this nature? Things appear chilly as of right now. According to figures from HM Revenue and Customs released this week, sales in January were down 11% from the same month last year. Many of those transactions took place before the skyrocketing mortgage rates. Buyer inquiries, agreed transactions, and fresh instructions are all declining, per RIC's monthly market report. And that's it guys. What do you think of the mortgage problem in the UK, and what may be its solutions according to you? Let us know in the comments below. For more videos like this, subscribe to this channel. Thanks for watching.